Hi folks, Scott here, and this is the wrap for Tuesday, September 10th. Real interesting price action here the past couple of days. You can see this white line here represents today's unfilled up gap. So that's yesterday's close, Monday's close, and then today, this is today's price action. Sort of the middle of these unfilled gaps. There's one way up at 1702 from back in late July, it appears. Maybe early August. But we also have yesterday's unfilled up gap too. So we have two consecutive unfilled up gaps. Pretty unusual. So I want to show you the results of fading gaps following two unfilled up gaps in a row went above the 200-day moving average. I actually had this question from a gentleman who, I'm not sure if he was a member or not, but regardless, I didn't recognize the name. He wanted to know if the odds were better for a gap up or gap down and which one had a better chance of filling. Tomorrow's gap or today's gap. Well, let me show you the results. And there you go. So fading gaps using an end of day stop, meaning no intraday stop, but just closing it out at the end of the day. If the gap has not filled, targeting gap fill when above the 200-day moving average shows slight odds for gapping up. Correction, for gapping down. That's what these long trades are. The long kind of gap down, you would go long. Gap up, you go short if you're fading the gap. And 18 of 19 winners by the end of the day have filled their gaps, resulting in a profit factor of 3.6. A gap up is actually about as good, 12 of 14, with an even higher profit factor, because it's just very unlikely to run or trend to the upside after such a situation. I think the concept is the market it needs to digest the move. It doesn't mean that it's going to reverse. It just may not go real far tomorrow because there's going to be folks on a gap up. Think about it this way. What if you were a swing long from a few days ago or longer? In the past 3 to 15 days, and you're sitting on some nice profits, you're going to be inclined on a gap up to consider taking some profits. So that's why we're more likely to see the market keep a lid on itself tomorrow on a gap up. But two unfilled up gaps in a row is normally a sign of strong momentum to the upside, and that's why the down gaps fill also. So consolidation is very likely tomorrow around today's closing price. Now I have shown, and I'm not going to show this now, but I've shown many times in the past. Members, you can actually look for this in our video database, which has about, how many, I should know this, 1,400 videos in it from my daily wraps of the past 5 years. The odds of this gap filling right here, or any gap filling, today's gap filling on the subsequent day, are about 25%. Meaning 75% of the time on the subsequent day, the gap that was just filled is not going to fill. So do not expect that to fill. I expect a gap up or down tomorrow to fill its gap, but not to come all the way down here. Now could it? Sure, 25% of the time it will. But odds favor it will consolidate tomorrow is my best guess based upon the historical data I just showed you. All right, let's look at today's data. We'll look at the worksheet first. We were gapping up above the highs of yesterday. So above the highs, using our worksheet, which summarizes the gap guides for the 8 individual indices. 62% historical win rate and a 1.37 profit factor. That's using MTG stop parameters, not considering slippage, but is considering commissions. So this meets my criteria. I'm generally going to fade anything that shows a 60% win rate and a 1.3 average across all the indices. And there's also good odds for going for the extended target. I'm looking for 80% and 80% here, and both of those are over 80. That just shows you that if you do get gap fill, odds favor some continuation through gap fill. In terms of unique days, there were no unique day factors, unique patterns, just an unfilled up gap from yesterday. That's generally increases odds of gap fill considerably. In fact, think of it this way. There have been 181 unfilled up gaps in the past under similar market conditions, above a 10 and above a 200. The data point I just showed you was what? 33 total trades? It was 33 total trades of two consecutive unfilled up gaps. So there was a 80% chance the gap, 80% chance that today's gaps were going to fill, but it didn't. So real rare scenario that occurred today, two consecutive unfilled up gaps. So with that said, you can pretty much go to the bank that I'm going to trade the gap. Today was different though. We had a large up gap That's even more rare after an unfilled up gap. And I even showed a large number of scenarios here, fading large up gaps greater than 40% of the 5-day average true range, or greater than 1676, when above a 200, and let's see, above a 10 after an unfilled up gap has been generally good. If it closed up between 0.75% and 1.5%, generally good. Greater than the 10-day moving average when the 50 is greater than the 10 and greater than 200, 50-50, but has been a moneymaker. UH zone after 10-day high close, a little more than 50-50, but also a moneymaker. In September above a 200, yuck, 6 of 21. So today makes 6 of 22. So September is just a tough month for these large up gaps historically. So this was pretty mixed overall in my mind, and that's what I said here. Unique pattern data showed mixed factors. Gap guides overall was slightly positive. So I had sort of a detailed scenario today that I thought was a good balance of risk and return. So for me to trade any gap with my core account, I have to have a 60% expected win rate. Today I didn't have that. In fact, let me explain that. This is an important concept. Because I know somebody who is sharp was saying, wait a second, you just showed us as a 62% chance. That's all gap sizes historically of these 2,362 trades that opened above the prior highs after a prior up day like we had yesterday. Today's gap above the prior highs was a huge gap, or a very sizable gap, way more than 40% of the 5-day ATR. That in itself is a significant subset of this total number, and I showed it in the trading room, but it dropped this number down to, for any given market, to around 45% chance of gap fill. So you have to drop these numbers by, say, 15 to 20% overall if it's a large up gap. So for me, with a large up gap, I just couldn't trade it, even though there were a lot of positive factors in play, without either using smaller than a half position size, 1/2 of my normal position size, or taking other action with my entry and stop to change the dynamics more in my favor. So what I decided to do was the latter, and I set up a limit short order to get filled after the open at 1681.50 with a 7-point stop, much bigger than normal because the size of the gap in this UH zone is prone to being volatile. Normally I'll use about 6-point stop unless it's a real large gap like today. And we'll take profits at plus 5 points and tighten my stop to break even, riding the rest of it. That's what I'm inferred there. I'll use a half size position and cancel my order if not filled by 9:45 a.m. Eastern Time and defer to the range guys. So the whole thought was the following. If the markets rallied right off the bat, which sometimes it will, squeezing folks from the prior day, just expand the ES here. If the markets rallied right off the get-go, there was a chance it was going to run up 6-7 points. Very common on a UH zone gap. So by delaying my entry to 81.50, my stop would be up at 88.50, which would have been right at, actually I was going to do 7.25 points, would have been at one tick above R3, which would have more than likely survived the initial run-up considering the size of that gap. And that's just from experience and testing. However, it sold off. So my plan was if it sold off, if it didn't rally up there and fill me at 81.50 in 15 minutes, I'd cancel the order. That's what happened today. I canceled it because I knew I'd have the 15-minute range guides to look for a low breakout opportunity. Low breakout opportunity did not look good on the 15-minute range guides nor on the high breakout. So I didn't set up any 15-minute range trades. I'd already canceled my delayed entry at 81.50. I did call out and execute a small discretionary trade, much smaller position size, at 80.25, one tick in front of the open, and I got stopped at the high of the day today, -3, as my dumb luck would have it. But you know, it happens. That's trading. Just letting a little motion get in the way. I just get a little tired of these buffaloes. But sometimes you go through streaks and you get buffaloed a lot, and that's a buffalo trade where I get stopped at the high of the day for a pull back a little bit. Still would have been a loser. We lost a couple points. And the other part of it, I was looking for 76 in a. Hold on. So I went short at 80.25 with a 4-point first target. 80.25. Oh, darn it. I was looking for 76.25. I was actually thinking my 4 points was inside the range. That's why it didn't get filled. I'm sorry, folks. I'm human. Yeah, darn it. I was looking at, so my target was set at 76 quarter. I was intending it to be 77 a quarter, which would have been +3. So I goofed that up. I cost myself money. I should have been a scratch trade today. My whole intent that I called in the trading room was to take profits just in front of the low of the day. Didn't happen. I lost 3 points on the discretionary trade. No other trade set up. The gap gotcha at the end of the day I did not do. Just tight consolidations like this generally don't work well on the gotcha, especially if you've already been stretched to the upside like we were today and yesterday. So that was my day. Good decision to not fade the gap of the open with my core account. So I'm happy with that, and screwed up a little discretionary trade, so I lost a little bit of money there, but hopefully we'll have a good setup tomorrow. And there you go. That is the wrap for Tuesday, September 10th. Have a